Okay, once again, my name is Shane Handy. I'm the founder of therationaltrader.com. We're going to talk today about wave volume and how I use it every day to find turning points, really to understand sort of what the market is telling me or what's going on in the market. We're going, oops, wrong screen. There we go. So here's our agenda. We're going to define wave volume, and then we're going to talk about the three basic signals that we're looking for. The first one's called no interest. The next is divergence, and then finally failure to push. And those are listed in the order that the frequency that you see them. Now, this is not theory. I run a live trading room. It's actually more of a practical trading lessons for 3 hours every day. I trade with real money live in front of people every day, and I use what we're going to discuss here as a way to understand what's happening in the market and what direction I want to go, specifically to find turning points. So I'm going to show a lot of charts today. These are trades, I'll point out the trades I actually took, and when we're done here, I'll send you to the link so you can see those trades taken live. I record everything, and well, most everything, and publish it every day. When we think about wave volume, what we're talking about is there's a natural ebb and flow to the market, and it's very similar to how you see the water coming in at the beach. The waves come in and the water goes out, and the waves come in and the water goes out. And what we're going to do is we're going to look at the force of that movement, and from that we're going to determine, well, we're going to glean some information about what's happening in the market. All right, so let's get to work here. We're going to switch to the live charts. This is the NASDAQ on the 23rd. That was Wednesday. Okay, let's get oriented. This is a 10-tick range bar chart. So each bar is 10 ticks high. This is the NASDAQ futures. The platform you're looking at is Sierra chart. I'm on the West Coast, so all the times you see listed are Pacific time. So this line right here is when the stock market opens at 6:30 in the morning. Okay, and there's other lines later on that I have the software draw that showed me key times, like when news occurs and the end of the morning session, things like that. You've got some horizontal lines on here that I have the software draw for me automatically, helps keep me oriented in space here. That orange line right there is the open. Okay, opening price, and this purple line is the last traded price at the close of the pit the previous day. All right, so you can see we had a small gap up here. This day was interesting because it was a hugely volatile overnight session, but we actually ended up kind of where we started. Here was the close the previous day. Fell hard, climbed hard. This is not a small move here. This is 42.65 to 25-ish. That's a 40-point move down, 60-point move up. Points, not ticks. Those are big moves in the NASDAQ these days. It's been fun to trade. So let's get back to our screen here. And the first thing to notice is, oh, I'm sorry, there's one other thing here, which is this square. I manually drew this rectangle. This is the first 5 minutes of the open. I have a policy where I don't take trades in the first 5 minutes. It's too volatile. So I can't do anything until 6:35 my time. All right, so now what do we see? You'll notice that the market moves in these ebbs and flows, and each one of these is a wave, or a swing would be the other term I would use. All right. So here, it advances, it pulls back. There's a question here: is it going to go, quite a bit higher, or not? Right? It doesn't. It rolls back over, advance, and what we want to do is understand, what's the force of this movement. Here it looks like the market's going to fall apart, right? You pull back, another wave here. And so the first thing that we'd like to do is get the software to draw those waves for us automatically without us having to look at it and try to decipher it, all right? And most trading platforms have an ability to do this. This is Sierra chart. The study is called Zigzag. It's a built-in study. and it's right here. And so let's turn this on, and we'll see that it's going to draw these waves for us. Now it's a lot easier to see the individual swings in the market. A key here is to understand how are we determining that a particular wave is over and when. All right. There's a bunch of different ways to calculate that. I'm using the simplest way I can because I want to make sure that I understand it and I can teach it, I can explain it. All right, so each wave completes when the market is reversed by a certain amount. All right, so we specify that. We tell the software this wave's done when the market's reversed. In this case, it's 20 ticks. All right, and so as you're trading, these waves are drawing, okay, and this helps you see visually what's going on. Now, what we want to do is understand for each wave, for this wave right there, how much volume traded in that wave. In that swing of the market, when it went from here to here, from bottom to top, how much volume traded. And we're going to do that for each wave. And that's going to give us some information that I think you'll be, if you haven't looked at it this way before, you'll be surprised at what you can learn. And in fact, I can't look at the market anymore without this because it's so valuable. So let's turn on, this is another built-in study here in Sierra chart that shows us the amount of volume in each of these swings. All right, so when we look at this, what we see is from here to here, well, here's the volume. It accumulates. It starts at the bottom, this amount of weight, this amount of volume, this, all the way to here. All right, and then once the wave reverses, it starts over. So the volume here is in this down wave. Okay, and then there's a little up wave, and this is that volume. Okay, so on and so on and so on. So you can see when you look at this, all right, that the market opened up. It was fairly even, and you had, you know, kind of a nice thrusty move down there. Not much up volume here, okay, and then a really strong move down, okay. So the wave volume, you know, simply stated, the wave volume is the amount of volume traded during this swing, during this wave, this up wave, down wave, up wave, down wave. Now, what we want to do is look at these patterns of waves as the market's trading, as the traders are participating in the market. How much force is behind the movement? How much force is behind this up move? And from that, can we figure out what's going to happen next? Or rather, can we figure out that what's going to happen next has a certain probability, something that we care about? All right. We're going to look for three things. Let's switch back to our presentation and talk about what those three things are, okay? The first one is called no interest. And in fact, when you look at the chart, what you can see actually is that there is a lot of volume in a particular direction. So here in particular, this really stands out, right? You see a lot of down volume here. A lot of people are interested in selling here. So I could say that this is the most interesting direction in the world right now. But what will happen though is there's a change, and it doesn't matter why there's a change. We can just see that there's a change because suddenly nobody's interested now in selling, and we're going to look at the wave volume to help us see that. Whereas where people used to be avidly selling, avidly buying. Now, where did all the sellers go? Where did all the buyers go? There's no more participation in that direction. Okay, and so what we want to do here is identify these cases where there is now no interest. There was interest, but now there isn't any. So there's a great example actually right here. Okay, if you look at this wave. This wave is falling, the market's falling, it's just falling apart actually. And then you get this response here. You see that? Here's the up wave. A lot of people are shorting it right there. The smarter ones are shorting it there. The less smart ones are shorting it there. Do not be this person that's shorting there. Who's selling right there? It better not be you. All right, that's a terrible place to sell. This is another thing that we focus on at the Rational Trader, is identifying the people who've gotten excited and are chasing and done something foolish. I want to compete against the fools in the market, not against the smart people. All right. What happens next is very interesting, because as soon as this bar here draws, you know that this wave is complete and it has this much volume. Look at the difference in the amount of down volume. You had an enormous amount here, a lot of interest in selling, and now you don't have any. Where did they go? Where did the sellers go? This is you hear me say this a lot in the room. Where did all the sellers go? Where are they? Not only is there dramatically less volume than in the previous down wave, there's even less than in the response. And in fact, we formally define this three-wave pattern like this. We call this wave here the initiating wave. Okay, this is the initiating wave, the wave that sort of starts our calculation. All right, and then this here is our response. So there was a movement, in this case it's a strong movement, and then there was a response. That's the response wave, the second wave of the pattern. All right, response wave. And now the third wave here is the signal wave. When this wave here completes, we can run some logic that says, well, look, the current wave, what I call the signal wave, if it signals, is less than both the response wave, right? It's less than the response wave, and it's less than the initiating wave. Where did the sellers go? This is a long signal. Now, that does not look like the market's going up. And yet it does. It goes up quite a ways. All right, so now let's go back. And what we want to do is, this is fairly simple logic, actually. All right. Let's turn on a study that will find that point for me. All right. It'll also find lots of others that you will now see pretty clearly. I'm going to turn on a custom study I wrote that analyzes these waves. It's called TRT wave volume. Let's turn that on. And you're going to get this purple triangle right here. That purple triangle is a no interest long signal. Now, you also see, there's a no interest short signal right there. Let's go look at that one. All right? This is the initiating wave right here. Right? It's right here. The response, nice healthy down response. Actually, there's even more volume in the response wave than the initiating wave, and then that's the signal wave, less volume than the previous up wave. If the market's going up, there has to be more volume, not less. Same thing here. If the market's going down, a lot of people think the market's falling apart here. It is, for the moment. A lot of people think the market's going down. There has to be more volume in this wave for that to happen. And if there's not, they're in trouble. The people that shorted here are in trouble. The market's not going down. The market's telling you here, the wave volume is telling you that there's no longer any interest short. It's now long. Okay? Short here, long here. This is the, oops, I deleted it accidentally, but this is in the opening 5 minutes, so I don't do anything here. All right? Let's move forward here. Had you gotten long here, there's an entry signal there. You get another no interest short here. Let's take a look at it. This one doesn't work out, and if you were long, what you would be doing is getting protective because it looks good, actually. Look, what do you see here? Here's an up wave. Nice volume. In fact, the most up volume you've seen all day. A bullish change in behavior, for sure. Okay. Here's the whole day. That's 7,000 contracts compared to less than 2,500 in all previous up waves. You get this response here. Now, if the market's going higher, you need to see that happen. And it doesn't. Right there. is when you get this signal, okay? And so this has you cautious about the long side. If you're long, you're tightening up. You could short this here. You'll end up taking a stop because the market does turn around here, all right? We get up to here. We're going to talk about this orange one in just a second here. I actually shorted this market right there, all right? When we're done here, I'll direct you to a link so you can see that trade taken live. The market falls apart here. There's another no interest short signal there. It's more of a pullback signal than a turn signal. It's not a turning point signal in this case, all right? This is NASDAQ on Wednesday. Is that right? Wednesday, yeah. All right, let's take a quick look at oil, and then we'll switch to the next signal we're looking for, which is divergence. I don't see any questions. All right, so let's move on. Here's oil. This is oil also on Wednesday the 23rd. This rectangle here I've drawn is when that weekly oil status report comes out at 7:30 Pacific. So, in fact, often we don't take any trades in the morning here because it's really choppy. Everyone's waiting for this news to come out. All right. The oil market opens over here at 6 o'clock. That's the stock market open. There's news. All right. This is a 10-tick range bar chart of CL. All right. That's the overnight high. That's the white line right there. Here's this white line here is the previous high of the day. These are drawn automatically by the software. It helps keep you oriented. After the news, what happens? The market just kind of cranks here up 35 or 40 ticks. Actually, not that much. You then get a down wave and an up wave that fails to go higher. All right. Let's turn on the wave volume, and you'll see exactly what we're looking for. Wave volume. I'm going to turn on the signals as well, so we don't have to do this twice. All right. So now what we have is you can see the waves clearly from here, here to here. All this, before the news is, I'm generally staying away here. You're getting some signals there. Now, after the news, this nice thrusty move up. Okay, that's your initiating wave. Here's your response wave right there. All right, and then the next up wave right there. No more interest. A lot of interest here. No more interest. I shorted this right there for this. Okay, no interest. There was interest and now there's not. And it's this particular, it's a basic signal. I say basic because you can easily execute this logic here to find it. The key is making sure you've got your waves set up correctly, set up nicely. All right. The next signal we're talking about, or that we're looking for, is divergence. All right, so we're going to talk about divergence right there, this one. So let's go talk about this orange signal. What's going on there? Let's switch back to our presentation. Whereas before we had for no interest, graphically, I'm looking at that as people have gotten bored with that direction. Divergence is trickier. Divergence is something's happening in the market, but it's actually an illusion. Something else is going on, right? And so you're measuring price, but then when you measure something else, you can see that what price is doing is not supported. And I like to think of it like the man behind the curtain in The Wizard of Oz, where Dorothy and company were all impressed by the show that the wizard was putting on. But then if you'll recall, Toto draws the curtain back from the wizard and shows that look, everything you're seeing is just an illusion. It's not real. All right, so for us, what we're going to do is we're going to use wave volume as our Toto. All right, and what we want to do is we want to compare what price is doing to how much volume is involved. And in the case of the session high or session low, you can look at the market and see, look, at this point here, I'm setting a new high. This was the previous high. The market's been climbing nicely. We had a decent long signal here. We got concerned about the turn right there. We kept breaking through. Nice volume here. There's just a sort of a normal pullback here. You'd like to be getting long there. The market's advancing. You're making new highs. There's a bunch of people buying right there. Make sure it's not you. That's a terrible place to buy. If you're going to buy down here. Okay. But what happens now? The market sets a new high right here. And we know that it sets it once this wave completes. This wave completes when this bar here draws. So it looks like this. All right, that does not look like the market's going down if you're just looking at price. That looks like the market's in a really nice uptrend. All right, but look at the wave volume. My initiating wave is here. I've got a response here. Decent down volume, by the way. Look at the previous down volume. This is starting to see an increase in people willing to sell, but most important is the here. I'm setting a new high on lower up volume. There should not be lower up volume. If the market's going up, there should be more volume, not less. This is the cleanest form of divergence I've ever seen. I'm setting a new high on lower volume. There's no ambiguity here at all. I shorted here. Again, I'll point, you can see that trade taken live. Again, this is not theory. It's practically applied every day. This catches, I caught 20 points here. The entry was something like 42.80. I got out too early, actually. I got out right in here. There's another 10 points to be had. Let's watch what happens next. This was divergence, right? I'm setting a new high on lower volume. Okay, that's a turning point, right? Earlier, we found a case where I did not set a new low, right? The market set this low right here on nice volume, but then when it's time here for the sellers to step in and take the market lower, this is their opportunity right there. That's their opportunity to push the market down. They want it to go lower. They sold, but they can't. There isn't any more sellers. There aren't enough of them. There aren't enough people that think the market's going down. So they start buying. Some of them are new buyers. Some of them are people covering from their short position. It doesn't matter. The price is going up. This is our turn. So we failed to go lower on less volume. Here is kind of the opposite case. We did break through, but on less volume. There shouldn't be less volume if you're breaking through. Look here. Look here. You're breaking through the high right here on substantial volume. Even right here, even though you're just kind of nicking it for the moment, it still has more volume here than right there. This one, uncertainty, right? I can't go higher. I don't have much volume. Looks like the market might be turning there. It's a perfectly reasonable short. As it turns out, there isn't a short entry there when you drill down and look for the entry. So wave volume gives us direction. I drill down to get an entry. In this particular case, there wasn't one. So it doesn't matter, because if you're long, you're not going to reverse here. You're gonna get protected and see what happens. Here, very clear, very strong signal. Divergence has precedence. It's so powerful. I'm setting a new high on lower volume. All right. Let's see what happened the rest of the day here. Divergence. I'm setting a new low on lower volume, dramatically lower volume, in fact. All right, now here's an interesting case, because this is a nasty down move. This is 30 or 40 points in the Nasdaq, a huge move in the Nasdaq. All right, so caution is warranted here. But look what the market tells you. Not that much later, you actually get a no interest long signal, because look, where did the sellers go? They already are absent here, setting a new low, giving me a divergence long signal. And then on the next wave, the next cycle, I have even less. even less sellers. This is a long signal. All right. So, no interest. I ran out of interest in that direction. Divergence. I'm setting a new high or low, but on less volume. The volume isn't supporting that break. Okay. There's one more basic signal we're talking about here. So let's go look at that. This is called failure to push. So when I break the high, I'm pushing through a key level, right? Or I break the low, I'm pushing through a key level. And our divergence signal is that I'm doing that on less volume. There's less support for that move. But what about the opposite case? What if I get to a key level and I've got a lot of volume, I've got a lot of force, but I can't get through it? It's the same thing. I like to think of it as Sisyphus pushing the rock up the hill, and he just can't get it over the hill, and it rolls back down. And this is our other case. Let's go back to the chart and see the practical application here. This is the same day we've been looking at, that last Wednesday in the NASDAQ. We have the 5-minute blackout ending here. And do you see that bright red outline right there? Let me make it bigger. This is the third signal. So our purple triangle is no interest. And the orange candle is divergence. I really make that stand out because it's so important. A bright red outline is a failure to push short. So look at what is happening here. The market's opening up. The high is right there at this point in time. It's right there. Okay? You got really close to it, but you didn't get through it. But look at the volume. The volume on this wave is to here. On the previous up wave here, you had this much volume. So you actually have more volume on this up wave, but you couldn't get through the high. That's failure to push. That's a short signal. This is actually a tough short to take because it just falls off so hard here. You'd like to see this to give you a place to understand where you're going to put your stop. All right. Instead, the market gives you a no interest short signal, so there's opportunity to get in here after that. So what we like to see actually is kind of what you see here, a wave volume signal followed by another one in the same direction. This is an entry. All right. Typically, I'll get this signal here, and then I'm using another order flow to drill down to find an entry. Same thing here. I get divergence here, and then I'm looking at the order flow. There's a very specific way I'm looking at the order flow to find an entry in here. It's safe to go in. But you don't need that actually if the market gives you another swing with a wave volume signal. So not only am I failing to push there through the high, but then when I fall, I don't see any buying interest. All right, so this is clearly a short here. It's just a matter of finding an entry that meets your risk to reward parameters. Here, all I get is a long signal. I set the low. I have a response. I pull back on no volume. Where did the sellers go? Where are they? No interest long, right here. You actually like this case because there's a very clear break level right there that helps you see that once you break through there, you can get long. This case here, divergence short, setting a new high on lower volume. A tough entry actually, it thrashes sideways, but the order flow really helps you. The order flow is showing you that there's buyers trying to push the market up but failing. It happened 3 times there. And then down here, I was done trading here for the day, but I really like that signal right there. Divergence, after a scary fall, so you're going to be careful. But then you can't argue with what you're seeing. There are no sellers. Where did they go? They're gone. Nice move up here. All right. In oil, wait for the news. A nice thrusty move here. A lot of buying. A lot of people excited about getting long. Market's taken off, or people caught short, having to cover. Where did the buyers go? Where are they? They're gone. So when we talk about being rational when it comes to trading, one of the things we're describing is the people. This is the oil market on Wednesday. The people that are buying here, here's okay on that breakout. There's probably a signal there in the order flow. But who's buying right there? That's foolish to be buying up there. Wait for that if you want to buy. Instead, what's happening is people have gotten excited, and we want to trade against those. We don't want to trade against the professional traders. Not with our small account. You won't survive. You'll get killed. Here's a good way to think about it. I don't know if I can find my image. Here's a good way to think about it. This is the situation that you're in as a trader, and you're not that big guy. A better representation would be, a dozen of these big guys and hundreds of the little guys. And of course, if you engage in this battle against the big guy, you're going to get killed. That's not what you want to do. You'd like to figure out what he's doing and follow along if you can. It's tricky because he's got a lot more capital, so he can withstand price fluctuations that you can't, both technically and emotionally, psychologically. All right. So what you'd like to do is find some other little guy to trade against. Okay. Well, guess what? They're right there. And in the NASDAQ, at least on Wednesday, they're right there. People buying this break right here are the ones that are going to fuel the move down. The people that bought right through here, these are the ones that are in trouble. As soon as this wave completes, which is on that bar, as soon as that wave completes, I'm sitting up and licking my chops because I can see there's no more buying interest. And now I need an entry signal that gives me a good risk to reward ratio. Okay. Now, let's see. Do I have questions? Oh, there are a bunch of questions. I'm sorry. How accurate are your entry arrows on your software? Well, Stephen, we use. I'm sorry, I got the wrong. There we go. We use wave volume for direction. Okay, and you can see this is Wednesday. It's just one day, right? So it's not a big sample size, but you can see how well we're figuring out direction, right? Very clear failure to push, a continuation, no interest short there. That finds the turn just amazingly well. That's a spurious signal. If you do that one, you're going to take a loss. Very, very clear divergence signal here. A couple of opportunities to get in. I don't really use wave volume for an entry. I drill down to the order flow, and the reason is that it takes time for the market to turn. So let's look at this example right here. All right, it's not magic. All right, we've told the software the market has to turn by this much before you understand that the wave is complete. So this wave here, it's not complete until you see the market advance by X ticks. In this case, it's 20. So it's this bar when that bar finishes. Okay, I've got a completed down wave and a legit signal. All right. Then I go to the order flow and dig in because I want to know on that bar what's happening. I want to know on this breakout what's happening. Do I have something in the order flow that says this is safe? All right. You can use a bigger stop. Just get your stop below here. All right. That's for the long, but that's often more than we'd like to risk, particularly with small account traders or newer traders who are, you want to risk as little as you can because you've got to deal with that fear and anxiety and doubt that you feel, especially the fear when you're putting money at risk. So you want to risk as little as you can while you're learning. You've got to face that fear and overcome it. It's really what the rational trader has been built to do, is to help you deal with that. Let's see. So someone's asking about Thinkorswim. I don't have studies written for Thinkorswim. The wave volume here, if your platform has the ability to accumulate volume through the wave, you can use what I'm describing here. It's not as convenient because the custom study there makes sure you don't miss anything, okay, that I've written. Dick, I'm day trading here. I'm day trading the NASDAQ. This is the NASDAQ here. But conceptually, what we're talking about, it doesn't really matter what the time frame is. You can swing trade with this. It's just a matter of increasing the time frame and making sure that the reversal amount is appropriate for that time frame. Okay, so actually in the tutorial we talk about how to do that. All right, so I'll give you that link in just a minute here. This is Larry. This is Wednesday. Wednesday's action, and you can see those trades taken live. Again, this is not hypothetical stuff. This is real. I practically use this every day. Okay, so Christoph is asking about cumulative delta. All right, so cumulative delta is interesting in that a lot of people like to use that for divergence, but what I found is that there's a lot of ambiguity or a lot of subjectivity in your decision on whether or not you're seeing divergence. Okay. Whereas there's none here. There's no ambiguity at all. I think this is much better than cumulative delta personally. This is the cleanest form of divergence I've ever seen. Your other problem with cumulative delta is that since you're dealing with where trades occur at the bid of the ask, there are times when you're getting a very strong move. It certainly looks like you're diverging, but you're not, because the bigger traders are raising the bid or lowering the ask. Stephen, yeah, I do this every day actually. So Steve is asking about live demonstration. I'm going to give you a link right now to tutorials that describe what I'm talking about here in a lot more detail. They're 4 or 5 hours long. It's free. So if what you heard today was interesting to you, then you might want to dig into that tutorial. We do what I just described here in more detail, and then we talk about order flow and then how you put those two together to create a very complete approach to trading. It includes links to the daily videos that show this in action. I record most of my trades live and then publish that every day, so you can see that. In fact, here let me give you the link right now. There's no cost, okay? The idea here is that, let me find the chat. Here we go. Let's see if I did this correctly. So from me to the entire audience, and okay, so if you go to that link, it'll bring up a page that's got links to the tutorials. It's 5 hours long. It's a lot of time. Very in-depth, very detailed. And then also links to the daily videos for Tuesday and Wednesday this week that show the stuff in action. And then a couple other things for you to take a look at. Let's see, costs. So Steve is asking about costs. Look, the way I run my business is I charge $95 a month to my members, and there are no other costs. All right, so one of the things I was trying to do when I started this education service is make it easy for people to try. I wanted to remove cost as a barrier. So there's no big upfront cost for the studies or the indicators. That's part of your membership. It's $95. There's no other hidden costs at all. It's very inexpensive. It allows you to try it without a big out-of-pocket cost. Does Sierra give you the volume chart, or is that yours? So the zigzag here and the volume down here, the cumulative volume, that's built into Sierra chart. It's not anything special I did. The signals here that are analyzing those waves, that's custom. I wrote that. Those divergent candles are proprietary, I presume. Yeah, so automatically identifying that this case is interesting is something that I wrote. That's the wave volume study. Let's see. I'm not able to open your link, really? Let me see. Let me try real quick. We have time here. I might have needed to do like www dot. Let's try that. Let me see. You might have to copy paste. It looks, actually, let me do it this way. Hold on. Give me just a moment here. Sorry about that. This is the first time I've used this tiny URL business here. Whoops. Just a moment. Almost there. All right, let's try this. Here we go. And if we continue to struggle, just send me an email, and we'll do it that way. Again, this is there's no cost for what I'm providing to you. If you, there you go. That you should be able to click that. Now that's my error. I'm sorry about that. You should be able to view that if you found this interesting. It's extremely in depth. There's no cost. Take a look at it, and then if you're interested, go visit the site rationaltrader.com, and you'll see that what we talked about today was a technical approach, but if you want to be successful as a trader, you also have to deal with that fear that we talked about, the biology of trading. All right, you must deal with the fear of pulling the trigger, the fear of missing out, the fear of giving back profit. That's the bigger problem that you have to solve, and the rational trader is built around understanding that these two things are required: technical mastery and biological mastery. And how do you solve them? Technical is easy, actually. Biology is hard. It's hard to change your biology. It's hard to master that. And I think I am out of time. So, Reed, if you're there, I believe it's time for you to take over. Let me check for questions while you're doing that.
I can definitely take that back from you. And if you wanted to answer one question, one that pops out to you, please feel free. I mean, we're right on time, though, so.
Okay, let's see. I think we got them all. People are asking about Sierra chart versus Ninja Trader or Thinkorswim. Those studies are written for Sierra chart. The Thinkorswim's not really I trade futures mostly. Thinkorswim's not a great platform for futures. Awesome for options, but for futures not so much. If you're interested in futures, you're going to really need to switch platforms. Ninja Trader, not supported yet. We'll have to see if Ninja Trader 8 has what we need. Ninja Trader 7 is not powerful enough. It doesn't have the data I need to do this.